Okay, another week. It's the first week of 2024. So we'll look at the week that was. This is the first market outlook where the last week was entirely in 2024. Last week was the last week of 2023. A lot of interesting things brewing. And we'll start with the jobs report from last week because this seemed to be a negative at first and then became a positive later in the day, and then a negative and then a positive, and the market just didn't seem to know which way to go on this. But initially it was a negative because of the headline number from the establishment report, which is 216,000. But when we look under the surface here, a lot of churn going on and a lot of interesting things. Look at the household number, negative 683. Labor force declined by negative 676. So just the decline in the labor force alone, because participation rate dropped to 62.5 from 62.8, could explain the negative 683. When you have a shrinking participation rate, that is the supply of labor shrinking. And if the demand for labor doesn't shrink, then the price has to go up. This could be a problem if we stop at this level here, but let's keep going. Unemployment rate 3.7%. If we look at who lost jobs, everyone did. Less than high school, 72,000. High school, 80,000. Less than BA, 243, and BA, 158. Look at the unemployment rates. Less than high school, 6%, 4.2, 3.1, 2.1. So it is clear, as education increases, the amount of time you spend without a job decreases. Not only that, as the amount of education increases, your pay increases. I don't know why we don't look at this as a source of income inequality. That if you are less than high school, and look at your unemployment rate and look how little you make. So if we think about your revenue as a square, where one of them would be your level of education and the other one is your pay, they are proportional, right? So, and as you know, the size of this square is not just 2 or 3 times bigger than the size of this square. If you double the length and the width, you get 4 times more. Just simple math can help explain a lot of the income inequality, that if we can figure out what can we do here, you could probably fix a lot, as opposed to going along and saying these people need to start paying for these people, right? I had to throw that in there because I saw these unemployment rates and I thought, well, can't we just look at something simple and straightforward and say, why don't we look at that? Less than 20, 95,000 lost. 20 to 24, 31,000. The 25 to 54, 290, and the 55 plus 287. These are your retirees, more than likely at the 55 plus. Canada job numbers came out. They were basically flat. I think we added like 1,000 jobs. And it was mixed between the types of industries. Half the industries gained, half the industries lost. But the biggest loss in the labor force came from the 55 plus as well. Look at this. This is what really got me. Full-time dropped 1.53 million. Part-time increased 762,000. Those are big numbers, and these are big discrepancies between that. 900,000 discrepancy between those two. Establishment shows 216, private at 164, government still spending taxpayer dollars as inefficiently as possible, 52,000 more for the government. Goods producing 22,000, and when we look at the diffusion index for manufacturing, it is negative 0.7. So the neutral employment or the neutral job gain on that, just to account for population growth, is somewhat higher. So even though you added 22 just to be neutral, would have had to be somewhere higher. Services 142. We look at their diffusion index 59.6, an increase of 3.3. So their neutral employment level is somewhat lower. By neutral, I mean it's the rate of job creation that you get each month that keeps the unemployment rate constant and simply just provides jobs for the growth in the population, but it won't change the participation rate, it won't change the unemployment rate. It's just the jobs that need to be created so as the unemployment rate doesn't increase because of population increases. So the economy is hiring above that neutral rate in services, but hiring below that rate in goods. Temp services, because that tends to be a leading indicator. If we look at October, November, December, temps lost 42,000 in October, another 22,000 in November, 33,000 in December. Average weekly hours, 34.3, is down by 0.1. Average hourly earnings, 0.439 for the month, 5.4% on an annualized basis. Now, I wonder how much of this is just front-end loaded and temporary at this point, as opposed to the beginning of a trend. We might say, well, going 62.8 to 62.5, you would see pressure on average hourly earnings, but we just got through a whole wave of strikes in the U.S., from UPS to the UAW to a number of different places with strikes. And some companies gave raises, non-union companies who didn't want unions, gave raises in the tail end of that to sort of avoid the possibility that the union is going to start targeting them or that their employees want unions. So there might have been a general price increase going into the fourth quarter of 2023 on the back of this union success. Some companies saying, well, we kind of have to give raises here, or we're just inviting a union ourselves. But I wonder how much of that is in this 5.4. The weekly earnings, because you have your hours drop but your earnings increasing, 0.147 is 1.78% annualized. So if we take the growth in weekly earnings and figure out, well, what would the growth in debt be? That would be roughly equal to the growth in retail sales that we can expect over 2024. If we're looking at, if we're just going to annualize these numbers, 1.78% wage growth, isn't that great? If you are paying people more but taking away hours, all that can be spent in the mall is what they go home with in their paycheck. Not what they go home with per hour, but what they go home with per hour times the amount of hours. That's all they can spend. And if their spending power on a nominal basis is up 1.78%, if you're expecting retail sales to grow 5, 6, 7% over 2024, there's going to have to be an increase in debt at a current Fed funds rate of 5.5%. Well, I say the overnight target rate 5.5. The effective rate is 5.33. Then credit cards are plus. It's hard to see how you can continue to have that kind of growth in debt to support retail sales. But then again, this is 1 month, right? Okay, let's see what rates are doing for us. Money market rates, all rather well behaved. The 1 month and the 2 month had ran up last week, and they've given back this week. On the long end of the curve, since we're in 2024 now, this is how 2024 began. So what we have down here is the change since the beginning of the year. And we can see since just in the first week, we've given back almost 3/4 of a rate cut on the capital market yields, all rising for the week. Curve inversions pretty much staying where they are, very little change. We're 543 days now into the capital market inversion, 430 into the money market to capital market inversion. Canada still more deeply inverted. SOMA continues to run off, another 37 billion down to 7.07 trillion. I think sometime in February we will start to see a 6 handle on this. Last week was 7.11 trillion. Actually, probably maybe even by the end of January we might see a 6 handle on that. The balance sheet did increase by 5.4 billion. It dropped 31.7, but runoff was 37.1, so 5.4 increased somewhere else. Money market funds, not surprising. It is the beginning of the year, so contribution space has opened up in tax deferred and tax-free accounts. So it's natural to put money to work as soon as you possibly can. And retail, increased by 78.61 billion, which is a big number. Retail up 37.87, institutional up 40 billion. Everything increased, but that just may be a function of contribution space opening up. That typically happens first few weeks of January for savers. For those that do contribute, they tend to have their money at the beginning of the year anyway, so why wait? Why not start earning your tax-free dollars as soon as you possibly can? So I don't know that this requires a question mark. I think it's just a function of the calendar that by the third or fourth week of January, we should get cleaner numbers on this without having the influence of asset location interfering with this. January 31st, FOMC, 24 days away. Probability shifting back to zero. No rate cut here. 93.8 up from 85.5, and 16.5% probability of a 1 in 6 chance here, roughly, of a 25 basis point. It's now 6.2. CPI in 4 days, PPI in 5 days. That will be looked at carefully. Hopefully the downtrend continues, and if the downtrend does continue, then I think we get back what we've lost on the S&P and what we've lost on yields. If it does tick up a bit, well, that is a sideways movement, or tick up a bit. That is not going to help things very much. Tuesday, there's a 3-year note auction. Wednesday, the big one, the 10-year note. Watch for that one. And then Thursday, you have the 30-year bond. This will affect TLT the most if that 30-year bond comes in at a higher yield than where the market happens to be when it's announced. I think there's more Fed speak this week, but all I've been able to find were these three: Monday, Bostic; Wednesday, Williams; Friday, Kashkari. And I think they take on more importance now that the Fed has signaled that it's going sideways, and that 3 rate cuts are penciled in, because the questions will be directed towards that. And maybe the comments will be directed towards tempering the market's view of more than 3 rate cuts. But this, combined with the note auctions, combined with CPI, make it a crucial week for fixed income. If you're in the grains market, the WASDE report on Friday is released at noon. Effective federal funds rate still sitting at 5.33%. Oh, I forgot to mention this here. The probability of 3 rate cuts or more was 85%. Look at that drop. It's dropped to 50.1%. The 4.25 is basically gone, even though it didn't have that much. Big drop here is to 4.5, 17.3 to less than 3%. And less than 3 rate cuts, 2 rate cuts or less, 50%. It's basically even odds at this point of getting to 3 or more, or 2 or less, basically even odds. 50% here versus 15% last week. So it's really shifted, and on the next screen we'll see that a full rate cut has been priced out of the market. The market was pricing in about 6 rate cuts. Now it's down to 5 rate cuts. The Fed is at 3, so they are moving closer together. So this data this week, along with some Fed talk in here, might bring it back to 6, or might close the gap from 5 to 3. I think it's a big week for fixed income this week. Reverse repo. I told you last week we naturally see it increase at the end of a month, more so at the end of a quarter, and even more so at the end of a year. When the end of the month is the end of the quarter is the end of the year. It was over $1 trillion. Look at that, 694. It dropped 324 billion in a week. It was just positioning for the end of the year, and that was it. The RRP put a new low in on January 1st, 664.89. Watch this. as this gets closer to the zero line, the conversation about tapering QT will start to increase. So this is sort of an indicator we can look at. And as long as money market yields are remaining above the overnight rate, and as long as issuance from the Treasury is ample enough to absorb those funds, and as long as private repos pay more than using the overnight reverse repo facility, then this will continue on its way down to zero. Why would I ever take less money when I can get more in the public markets, right? And if that hits the zero line, or as it starts approaching the zero line, the conversation will head towards QT. And we saw in the last minutes that they sort of have, that somebody had raised it, or a few participants raised the idea of beginning to talk about the end of QT, beginning to talk about where they're going to start to stabilize the balance sheet as the RRP comes down. My estimation is somewhere in May, based on the speed at which it's come down over the last 3 months, from October, beginning of October to beginning of, we'll call that beginning of January, was at 1.28 trillion down to 664. And that's a 3-month rate. At that rate, if it continues at that rate, sometime in May, this will hit the zero mark. But the conversation is going to start sooner than May about when the end of QT is. And QT won't just end. You know, you'll go from, I think we're, 60 in treasuries and 35 in MBS. Might go to 40 and 25. Then it might go to 20 and then 15 and then 0. Right? This may take, you may start the taper. You may start to see the taper maybe if we're in May, sometime in the summer. It might taper down. You might be all the way to the end of, I don't know, mid-2025, end of 2025 before they simply stop. But they're not going to run it off and then say, okay, we're done, and then immediately stop it. It will be tapered. So I think the conversation from the Fed will be about when do we start to taper QT, not when do we start, not when we stop it, but when we start to taper QT. And again, as this approaches zero, that conversation will increase. And I think sometime in May, this probably gets to a point where they're going to have to think about, well, what are we going to do on this side? Okay, real rates have all increased, and I think that is to the relief of Fed officials, because it is the real rate that they measure as being restrictive or not, because you have a dynamic inflation rate. If you have inflation coming down and nominal rates are solid, real rates are rising, hence monetary policy is becoming more restrictive even if you're not raising rates. So seeing them increase, I think, makes them a little bit happier that their policy, their restrictive stance is being held in place and not being messed up by the market. Inflation expectations have all increased as well. I think that was because of the average hourly earnings out of the December jobs report. But here's the thing with this data, right? Is you're always looking into the unknown, which is the future. Was it a December anomaly? Was it a result of all of the strikes and all of the successes unions had that everyone felt, or other companies felt we need to do something so that we can stave off the union? Or was it the drop in the participation rate that then squeezed wages on the way up? Well, the household data doesn't support that, because the household data shows a loss of jobs. So nobody could have been hired at higher rates if you have a law. I shouldn't say that. There's always churn going on under the surface. But the establishment showed 216. I don't know if 216 is enough to be able to promote that kind of 1 month increase in average hourly earnings. I think it's more a function of preemptively paying to avoid possible unions. But still, we have this creeping up, and we have CPI on Thursday morning. For the Fed funds futures, Now 128 basis points. By the end of June, 52. So June, for the first half of the year, seems to be firm with 2 rate cuts. That 2 rate cuts will happen by the end of June. And then end of September, another 40. End of December, another 36, which is about 1.5 per, 1 to 2 per. I don't know which one, but either way we come to 5. If it's if we say that this one is 2, it makes this one 1. If this one is 1, it makes that one 2. You see where I'm going there. But we were pricing in 6 rate cuts. Now the curve is pricing in 5 rate cuts. So if you thought that 6 was too much and you shorted the December Fed funds futures, you did quite well, almost a whole rate cut. TLT down 2.62%. Couldn't hold its gains. It tried 100. It failed at 100. My thinking is that it probably may retest 95, or that 95 seems like a place where it probably would find support. And we ended at what, 96.21. You can see the uncertainty here on Friday. This is the release of the report. No, we don't like it. Actually, we do like it. No, we don't like it. And okay, I think we're good. Right? Which increased volatility. The 13-week implied volatility percentile, the 24th percentile, up from the 8th percentile. All the percentiles increased. SPY down 1.52%. And listen, it was a good run. From like mid-November right through to the end of December, it was a good run. That this right here last week, I don't know that this really causes me much grief on this. I look at that and I say, look, we had a good run. I did cover my January 19th, the 2024 calls. Remember, I had reported to you that I had sold $100 calls against my remaining TLT position. I still have 7,500 shares because I'd converted quite a bit to bond holding. So I sold 75 of these for a gain of a little more than $1, which isn't too bad. So this 96.21 for me is somewhere around 97.25 because I was protected by at least $1 on the way down. It's nice to be selling again. I don't know if I'd do it again because I have a hard deadline of I think it's the end of January to January 18th, I think, to move my assets, whatever remaining I have left. So I don't know that I can get that done again. Okay, 30-year fixed rate mortgage hardly budged, only 1 basis point, still hanging out at 6.6. Last week was 6.61, 6.62. 10-year Treasury increased by 15, so the spread decreased by 14. We're at 263.25 on that spread. Nothing performed well this week. Agency, Annaly, and ABR all gave back. The IYR, the REIT index, gave back. PLD and DLR gave back. The home builders gave back, except for Lennar in there, but everyone gave back. Which, I mean, the market basically on Tuesday was down, on Wednesday was down, on Thursday was down, on Friday was all over the place and eked out a small gain. This is interesting. If we look at the OAS, look at what's going on with the high yield categories. The spread widening, 39 basis points from 332 to 371, 11.75% widening on the spread. Double A. Oh well, I don't know why I circled double A here. I meant to circle double B. Double B 14.36 and triple C 11.09. So those are big moves in high yield. I tried to find a maturity schedule for high yield debt in the U.S. That's proprietary data. You're going to need a data aggregator to get that done. I couldn't find a good source for that, but I did find some numbers. Some 70 to 80 billion maturing in 2024. I mean, overall, considering the amount that's outstanding, that's not a big deal, really. And if interest rates start dropping in 2024, as these things start maturing, they will mature at lower rates than where we are now. Not only that, if we look at where the spreads are compared to where they were a year ago, the spreads are lower than where they were a year ago. So it could very well be that as the debt is rolling over, as opposed to rolling over 300 or 350 basis points higher, it could be rolling over at about 150 basis points higher. Still higher, but 150 basis points. So it could work out that as the Fed is cutting rates, if they have 3 planned this year, as they are cutting rates, as the spreads tighten a little bit more, as these companies' debt becomes due, they might be able to roll it over for the same or even lower cost. December, not much of a month for issuance, but you can look at last December, not much there either. Investment grade, another 20 billion. High yield, almost 11 billion. 2023 versus 2022. In terms of issuance, 2023 saw 5.4% more issuance in corporate debt than 2022. So when you think about high yield here, 10.9, you look at that, all these are high yield. When you think about 70 billion coming due over the next year, if you're issuing an average of 10 to 20 billion in high yield every month, you're talking about a 4-month supply coming due over the next 12 months. I don't see that that's going to be a thing to watch. I think that the commercial real estate on regional banks will be a thing to watch, but I think the Fed will provide as much liquidity as is needed in that space, and I think that private real estate and private credit may step up and fill in some gaps there. Okay, before we move on to SPY, forward earnings and earnings reports for the week, we haven't really talked about geopolitics too much all last year. I don't think I mentioned geopolitics at all. Last time I mentioned it was the invasion of Ukraine by Russia. And I simply just made a point at that time saying, look, the longer this goes on, the more it will be normalized. It won't be part of the conversation anymore. It'll just be background noise. And for the most part, throughout last year, it was background noise. It really didn't affect markets. It's not as if we woke up on certain days all fretting about what's going on in Ukraine. I think the only real conversation today about Russia and Ukraine is the extent of support we continue to provide Ukraine. I say we, the collective West, provides more and more voices from the population. Not so much leaders, but the population are saying, we got our own problems here. You keep taxing us and sending the money here, and it doesn't seem like there's a solution to that problem. There's another event going on, which is Israel versus Hamas, which has been going on since the beginning of October, but really hasn't affected markets that much. I think that's probably going to change, or at least has a very high probability of being the thing that markets are going to talk about. This just came out over the weekend. China's Costco halts shipping to Israel. You have the issue with Iran and ISIS with the terrorist attack in Iran. Now it has nothing to do with what's going on in the region. They're just capitalizing on the time and the location. It just adds more anger in the region. You have Israel and Hezbollah trading shots, and Hezbollah firing missiles into Israel. You have the Houthis in the Red Sea attacking ships, and you have U.S. military presence trying to counter that right now. And you have a sort of growing voice, more so among the pro-Israel side, that Netanyahu has to go. That his actions and the strategy that Israel is following right now is isolating or beginning to isolate Israel from the international community. And this is just one more thing, China halting shipping to Israel. But I don't see Netanyahu leaving. He needs the protection of the position that he's in. He's very much like Trudeau in this respect, that even though the people don't like him, he's not going anywhere. It's about his own brand over the brand of the nation. What's good for him versus what's good for the nation versus what's good for the world. I don't think he's going anywhere without a fight. I would think on a going forward basis, this has the real potential to escalate in the conversation about markets. So not only do we have price risk in terms of inflation that we have to look at, not only do we have earnings risk in terms of companies reporting what earnings growth looks like that we have to look at, not only do we have the wall of maturity on commercial real estate that we have to look at, this I think is going to become part of the conversation. And when you add them all up, that's a lot to worry about. What would be a natural play on a possible increase in geopolitical risk in this region? Energy would be the natural winner on this one. So I think it would be long energy. Okay, let's turn our attention to the large cap index, SPY forward 4-quarter operating earnings coming in at 241.93 because Q4 of 2023 is now out of the picture. That is what we'll be getting earnings for. So this 241.93 is all 2024, Q1 2024 to Q4 2024. We've had to move ahead, so that's why the jump from like 232 up to 241. Closing SPX 46.97 puts it at a 19.42 forward multiple. So the combination of the increase in earnings and the decrease in the SPX took basically a whole forward point off the multiple. Implied volatility coming back in, 13-week at the 54% level versus 11%. And we are now sitting 1.92% below an all-time high, which is still 44.7760. You can see the red bars here, Tuesday, Wednesday, Thursday, with one green bar on Friday, but not without a lot of hand-wringing. Market was down, market was up, market was down, and then at the end of the day you look, oh yeah, I guess we're ending with a gain, which I think is a positive. Next week we are going to be dominated, I think, with headlines out of the Middle East. I think that is an issue. Most geopolitical issues that arise usually have an initiation date, a flurry of activity for a few days until everyone settles down, and then even if the event doesn't disappear, it just sort of drifts into the background. This one is escalating, so I think that conversation comes more into the forefront. Not you've got that. You've got CPI on Thursday, PPI on Friday. Here are all the banks reporting on Friday: Bank of America, Bank of New York Mellon, Citigroup, JP Morgan, Wells Fargo. Some big ones here. And then United Health is reporting as well. Earnings for the month of January. We have inflation coming out. We have Fed speak coming up. You have bond auctions coming up. And if they come in at higher yields than where the market is, it could get ugly for the day for bonds. And you have geopolitical tensions that are not just rising. I wouldn't even call them geopolitical tensions. The geopolitical skirmishes are rising. Not just the tensions, but the skirmishes are rising, and countries are picking sides. So, yeah, 2024 sounds great. Now, last week I had given my thoughts on my best bets for 2024, and it was noted that I said nothing about the S&P because it's not one of my best bets. I'm indifferent. I mean, I could easily make the case that we're in a position to move higher, but I could easily make the case that we're in a position to move lower. And when you're sort of undecided like that, it's not a bet. It's not a trade. I want asymmetric trades. I want ones where no matter what the outcome is, I'm probably going to win. This one here, it's win or lose. I don't know. But if I had to, and I did this in the Q&A session, if I had to put a forecast on the market in terms of where I think it would end the year, I came up with about 4,400 just by using a more realistic multiple of where earnings were and applying an expected return based on a decomposition of a Gordon growth model into a short-term model. So you have a dividend yield, we'll call it 1.8. I think it's more like 1.7. Put a share buyback percentage onto that because that is a form of return to shareholders. I put 1% on. You have corporate earnings growth. Now this is a difficult one to figure out. In the Q&A video, I just used Q3 earnings growth, which was fairly high. If we look at all of 2023 and what the earnings growth was there, it was not very good at all. You had 0.6%. Long-term average is 8.4. I think the forecast for 2024 is 11.6. So you got a wide range. You can use 0.6, the 2023 number, and assume that 2024 earnings kind of be the same environment as 2023. You could use a long-term earnings number, or you can use the forecast. Pretty wide range, but let's just take a worst-case scenario. We'll use the 0.6, and then you have a correction on the multiple. That if you do have a low growth environment like 0.6, you probably aren't going to have a 19.5 times forward multiple, maybe an 18 times forward multiple, which is a drop of about 8% on the multiple, which is the third component of Grinnell-Kroner. So that's giving you 3.4 and 8. That's giving you about negative 4.5%. Return on the index for the year, negative 4.5%. So if you take the 4,700, then roughly about 5% lower, 235 points lower, you're under 4,500, 44 and change. So if I had to pick a year-end target, I'd be saying 4,400 is the year-end target. But if you do have robust growth, 11.6, you probably aren't going to have a PE contraction at that point. I don't know if you'd have too much of a PE expansion, but maybe you can go to a 20.5 if you have 11.6% earnings growth. So if you have a 1 point expansion from where we are now, it could add another 5%. On. So that's what, 16, 6, 17, 6, 18, 6, about 19.4%. If earnings are going to come in, so as earnings are coming in, if it's looking like there is significant growth year over year, then yeah, you could get a market that starts to move up to price in potentially a 20% year over year increase. You get 20% year over year. You're somewhere around 5,500 for the end of the year. Look how wide that range is, 44 to 55. That's a big range. Now you could say, hang on a second though, you're at 47. You have a range of 44 to 55, which is 300 points to the downside, but about 800 points to the upside. That's asymmetrical enough, isn't it? True. But the 44 is not accounting for anything else other than what Grinnell-Kroner can account for, right? I think the income component is not that controversial. Where the wild cards are the earnings and the multiple, the change in earnings and the change in the multiple. That you have rising geopolitical risks, you have rising energy costs. If you have that, inflation starts to show up again. Perhaps you have a Fed that doesn't cut rates when it wants to cut rates or when it was planning on cutting rates. And you could get a year where earnings don't even have 0.6 but might have negative 5%. And if you have that, you could probably get negative 10% return on the multiple. So suddenly you're down 13%, not just 4.5%, which would put you somewhere around sub 4,000 by the end of the year. You could easily make that argument. That's not an unrealistic argument to make. So when you're in a position where you're looking at these outcomes and you would think, but I'm probability-wise, I don't know that I'm that different on them. That when you're 50-50, it's not a trade. I don't know. I honestly don't know. I would not be surprised on either outcome, because it is in the realm of the narrative and the possibility that could happen right now. But if I did have to lay a bet, I would bet the end of the year is lower instead of higher. If I did have to place a bet, how much lower? Well, 4,400 to me seems like a reasonable number for the end of the year, but the path to 44, who knows what that could look like. It could go to 38 and then rally to 44. It could go to 52 and then sell off to 44 at the end of the year. Who knows? But that is about the best that I can do. And if that's the best that I can do, I would look at that and say, that's a casino bet. That's not a market bet. That's a casino bet. I don't have the willingness to put a money bet on U.S. beta at this point in time. When I say U.S. beta, macro beta, like a top-down S&P bet. And that's it. Lots this week. Two big bond. You got the 10-year and the 30-year. You got CPI and PPI. You got bank earnings coming up. You got 3 Fed speakers, I think probably more. And you have growing tensions, where growing tensions, have always been, but seem to be more of an issue now.